So today I'm going to talk about Cakebox, and I'm going to talk about this in a little bit more of, I would say, a negative way. I was a little bit disappointed with what Cakebox did yesterday, and for you guys that own Cakebox, because I know some of you guys are shareholders, I'll give my opinions on that and why I was a little bit disappointed as a shareholder. So hope you enjoyed this video and let's get started. So yesterday Cakebox brought out a trading update, or they gave a business update in their AGM meeting, which we'll look at in a second. And because of this update, the stock was actually quite positive. The stock was up at one point, I think it was up 6%. At the end of the day, just short of 5% up on the day. And I'm a Cakebox shareholder. I have been for around about a year and a half, and obviously the market liked what I heard, but for me, it was the first time I looked at Cakebox and went, I was a little bit disappointed, and there was a few really basic errors made in the company that I was quite surprised by. And I know quite often some management teams do come and watch this video, and you guys as shareholders, obviously, if I ever see something that I'm not happy with, I'll tell you guys it, and this is it today. So it's currently 62 million market cap, around 14 times earnings, but there is a drop off in the profit at the moment because of the investment they have made, and it is 5% dividend yield. Now, as we know for Cakebox, it has been a bit of a choppy time. Obviously, we can see here IPO'd, and the share price has basically done nothing since it IPO'd, but you'll see here there was a crazy run up in the share price where it did go a little bit bonkers, and since then the shares have suffered through a few things. There was a lot of negative sentiment in 2022 that never helped, especially if you're a little bit of an extended valuation. But there was a little bit of an error from the CFO in the accounts, which they have changed the CFO and rectified since then. So even though that was a crazy drop caused by that, I think mostly it was caused more because it was in the peak of like the bear market, which did not help. And then there was a little bit of a profit warning over the summer of 2022, which once again they have resolved. But unfortunately, that has left a lasting impact on the share price, which is a bit frustrating to see as a shareholder. But in the longer term, I think they will reflect a better share price as the fundamentals improve. Now, getting on to what happened yesterday. So they actually posted an AGM, and they also gave an update during this AGM. So you can see here AGM statement and board update. You can see here that the group is providing an update for the 17-week trading period of 30th July, and you can see here franchisee stores like for like increased 6.8%. So on first reading, you're thinking, yeah, that's pretty good growth. 6.8% for me. I always think the company, I always expect it to grow 3, 4, 5%. Obviously, this is a lot better, and analysts are actually quite aggressive on this. If you actually look at analyst forecasts, they're actually expecting Cakebox to grow more towards a 10+% clip every year. So I'm always a lot under what analysts are expecting here. I always expect lower single digit growth, and they actually go for double digit growth, which is obviously really good amounts of growth. So obviously keep that into consideration. And obviously this is like for like sales, so actually when you add new store sales on, they are going to be closer to that 10% as it says here. So they are very much look like they're performing where they should be. You can see this is an increase from 5.4% like for like for the first 11 weeks of the financial year that they posted on the 26th of June. So obviously showing, oh look, we're improving our sales. Now you can see here that they also said there have been some improvements in input costs to the group. So that's obviously like the likes of gross margins should start increasing this year. Obviously there was no clarity on how much that will be, but that's the suggestion that you should see some improvement from the gross margins point of view. They also announced that they have had a new website go live in June 2023. Now I'm not sure if any of you guys actually used the old website, but it was terrible. There's no way to put it. The website was for something that it seemed like it was from a website that would be around 10 years ago. So it's good to see there has been a bit more improvement into the website. And I've got to say, I was actually flicking through the actual store locations. I always just do this. I go have a quick look, see how they're expanding. They've actually got one in Scotland now, but it's crazy to still see, like when you look at Scotland, like there's not many of that locations. You could have one in Aberdeen, Edinburgh, Dundee, for example. I'm sure the population of Fort William is quite large as well. You've got Belfast, for example, expanding into Northern Ireland. So there's a lot of expansion in Northern Ireland and Scotland still to be had. But I mean, I was even looking through like other places like Penrith, Carlisle. I was looking at the likes of the Lake District, potentially, the likes of Whitby, Scarborough, Bridlington, York, Harrogate's a pretty big location, Blackpool, Morecambe. I even saw like Lincoln not having a location, and the likes of Chesterfield. I can't find where Norwich is. This is for putting my geography skills to the test. Let's try find Norwich. Here we go. No location in Norwich. as well, which I was quite surprised by. So there's still plenty of locations for them to improve on. So yeah, I mean, obviously I just want to say, like, the website looks a million times better, but also showing you some of the locations as well. And I really like this feature. This looks a lot more modern. The only thing that I did find is every so often when I did start clicking on a couple of things, the website, like here, I'm using the down arrows on this website and it's not scrolling until I click on it. So there's a few little teething problems there that this is me being very picky there, but there's still a few improvements. But the website looks a ton better than what I did. So obviously that's really good that they've improved that. And you can see here there's a new 7 stores opened, and the group now has 212 stores. And he said on the outlook, obviously we're expecting a good outlook here. And he said the company is also going to hold a capital markets event for investors and analysts to provide an update to the group strategy on the Wednesday, the 18th of October. So that's something to stick in your diary if you are a Cakebox shareholder. So obviously from that point of view, it looked pretty solid. Now the problem is they went on to do an interview, and they did this on Vox Markets. They always seem to do a interview on Vox Markets after they posted the statement, which is absolutely fine. Obviously this is a time where you can drop some gems. And they did drop kind of one little gem there, which was that they are a very profitable company. They also do hold a very good balance sheet, and they do hold a good amount of cash on the balance sheet. And they did say they have now paid the debt off on the balance sheet, which obviously I think is a good move. You know, if you are sitting on, I think it's 7.4 million. And they did pay down the debt on the balance sheet, obviously, especially in a higher interest environment. I think that's absolutely fine. I'm happy with that decision. However, when they went to go on to do the Q&A session, and like I said, it's not normal like this, because normally there's some good information in there. I was a little bit disappointed to see them do only an 8-minute video. And by the way, I have asked Shukshmal to come on to the YouTube channel of JKI Investing, and I've never got a reply from, which is also very disappointing, because obviously there's a lot of you guys that are Cakebox shareholders that would like to get some information from him, so it is disappointing. And normally there's a lot of good information given, but in this interview I would say about 8 minutes, out of those 8 minutes, 4 minutes were basically information that we've heard before, and in those 4 minutes there was a few things that was a little bit disappointing. So they didn't really give much clarity on how much the gross margins will actually improve by. The second thing is talking about partnerships. You know, I think one of the big things that Cakebox is going to expand by is the partnerships, the supermarket partnerships, investing into more kiosks rather than the actual big stores. There wasn't much information given about that, but the really big surprising thing that they dropped in here is that when they talked about their revenue growth, which looks pretty good from this point of view, when it was 6.8% like-for-like sales, the problem is they actually said, and I don't know why they said this, but a lot of the sales did come from price increases. So they actually said they haven't seen much volume increase. The actual reason why the revenue is growing is because they increased the prices, and they didn't do this last year, which was probably why it was a little bit more impressive. But to see the prices now get hiked up, and really they said the only increase in revenue is from them and not actual sales, not volume, I was like, okay, that's a little bit worrying. So you're basically coming out and saying that if it wasn't for increasing the prices, we wouldn't have seen growth. And I was like, you know, those are the sort of things that you don't want. I mean, fair enough for being honest with us. I mean, let's be straight up, but you don't want to hear them sort of things. And the thing is, like, you look at a company like Greggs, which is a company that I think is quite similar, a good one to compare with Cakebox, is that when you look at Greggs, for example, their stock actually got punished. You can see this little dip here, and since then the stock is actually down 11%. They actually brought out a trading update not so long ago, and they brought out a trading update, and you can see total first sales were up 21.5%, and company managed like-for-like sales were up 16%. And everyone went to Greggs and went, yeah, it's 20% growth, but it's just pricing crisis, so it doesn't really matter. And it made me laugh because everyone looked at Greggs and went, yeah, 21% growth, it's only because of price hikes. But then I look at Cakebox, it was up 5% today, and I was looking, and maybe because it was on an interview and not actually on this statement here, if people actually realise that the actual revenue growth came from actual increases and not volume sales, it's a good job they didn't put volume sales in. I actually think the stock might have took a little bit of a wobble there today. So, I mean, obviously, you know, people are saying that it was, for Greggs, they're up 21%. But the problem is when you look at inflation, you know, inflation's up 10%. So when you look at something like a Cakebox, for example, they are probably actually behind inflation. So obviously that wasn't good. So I think that they got away with it here a little bit because obviously it was on a smaller based interview. But if that made it into the press release, and that's the reason why it didn't make it into the press release, obviously, yeah, I think the stock might have had a little bit of wobble there, and I think they've got to be very careful about what they're saying to the markets. Now, even though the 8-minute interview here was a little bit disappointing, there wasn't many gems dropped into the interview. Obviously, I'm still a Cakebox shareholder. I am holding for the longer term, and I do think the company will still do okay. But there was a few things there just to be keeping an eye on there. But obviously, a 5% dividend yield is very attractive. Hopefully, the company goes back up to good amounts of growth, and that profitability as well goes up a little bit. And these lower as well profit margins, obviously with prices decreasing as they drop down to 12% here, go back to the historic kind of growth rates. And also from a valuation basis, obviously it trades at 14 times earnings. Obviously there's a little bit of drop in profitability at the moment because of the investments they've made, but I mean previously the company used to trade at a historic valuation, as you can see when it IPO'd, 26, 23 times earnings, 20 times earnings, 21 times earnings. When it went a little bit crazy, 31 times earnings. So it also used to be higher valued as well. So it's what I talk about all the time, is that sometimes the big mover in share price isn't because of the revenue growth, profit growth. It's because sometimes the market goes, we're going to value at 14 times earnings, or as it was before 2020 or 2022, should I say, we're going to value at 29 times earnings, and that's a big thing. So I think that obviously the big thing with Cakebox is hopefully they go back to still growing that profit and revenue. Obviously they've got a very good balance sheet. You're also going to pick up a 5% dividend yield, and hopefully the company trades at a little bit of a more respectable valuation for a company that is growing revenues in the longer term like they have done previously when you look at the past valuation. So just before I go, obviously let's have a quick look at some numbers here. So I did have a look at some of the numbers. I have not put a buyback in because obviously I think they're going to be obviously paying a dividend more than anything. Obviously, big thing to factor in is that you are going to collect a 5% dividend yield from where it is right now. So obviously that's not a bad dividend at all, and that's obviously going to help your share price return. But I put revenue growth of 6% in. Now, obviously, like I said earlier, that's what I think they'll do. Obviously, analysts are a lot more bullish than me. Obviously, analysts are expecting revenue growth of more towards 10% every year, which I think is a little bit harder now they're quite a sizable company. I think obviously they can increase the prices a little bit. Obviously, new stores obviously try help them a little bit, but I think that's still really big amounts of growth there. So I've gone 4, 5, 6%. Profit margins, like I said earlier, I've gone 15, 16, 17%. The company at the moment is having low profit margins because of the investments that we've seen and the material costs as well. So obviously they've dropped down to 12% at the moment. So I'm expecting some improvement there. You can see historically they have been around 19, 18, 21, 17, 18, 17, and they got to 16% around there. So when obviously I look at the profit margins of 15, 16%, it's about what they were at previously. So I am hoping they can improve those profit margins a little bit from here. And I have put a multiple of 20 times earnings. Obviously at the moment it is at down, what did we say earlier? It was 14 times earnings, so I am expecting a little bit of multiple improvement there, something to bear in mind at the moment. Now obviously if we look at the moment, the upside is on the lower side with 4% growth is 93%, the middle side is 114%, and the high side is 136%. So I do think in the next 5 years we will see Cakebox potentially come a 100% return member. Let's just say on the really negative side, obviously 93% would be just a little bit below it. Let's say worst case scenario, let's say the market does trade it at the same valuation that it is at now. Let's go down to 15. So it would still be at 44% return, 45% return, which isn't too bad. Obviously you got to factor in then you got the dividend and probably dividend growth as well. So obviously that will help you get up a little bit. So even if worst case scenario, it does trade at a lower multiple, let's say profit margins don't recover as much, it does grow a lot slower, the market trades it lower. I mean, obviously still with that factor in and also the dividend, it's still not a terrible return, but I think that we should see it more towards these middle and high side, especially when you factor in that dividend. So I still think it'll be okay. I still think the company is in a good place and the long-term story is still here. I just think management today could have done a little bit better. I think they could have done a little bit better being cautious about what information they are kind of telling the market there, and also be a bit more open to the investors about potential partnerships, the expansion they're trying to do. I don't really see the point of doing 8-minute interviews with 4 of the minutes already information that's kind of known, and also the improvements they are making, but there's still a few things that could go a little bit better on the website, for example. So hope you enjoyed the video anyway, guys. If you could hit the special like button if you're on here, subscribe. I'll catch you all in a bit.